Hey everyone! Today, we're diving into a question that's on a lot of people's minds. Is it too late to be more aggressive with my KiwiSaver? Now, I know what you might be thinking, but hang in there, because this is a super important topic to get right. So, let's break it down. First off, let's talk about what KiwiSaver is. KiwiSaver is essentially a retirement savings scheme in New Zealand, and it's a pretty popular way to save for your future. Now, there are different types of funds within KiwiSaver, and one of them is the aggressive fund. These funds are known for their high-risk, high-reward nature, investing heavily in growth assets like equities, which can fluctuate in value. The thing is, aggressive funds are not for the faint of heart. They can lose up to 30% in a year during downturns, but over the long term, they tend to pay off with an average return of 10.3% per year over the past decade. Now, that's a pretty good deal, but it's not for everyone. So, why would someone consider being more aggressive with their KiwiSaver? Well, it's all about your personal risk tolerance and investing timeframe. If you're young and have a long way to go before retirement, you might be able to handle the volatility of aggressive funds. But if you're older, say in your 40s or 50s, it might be a different story. Now, here's where things get interesting. Some people might think that being more aggressive with KiwiSaver is only an option for the young. But here's the thing, you don't have to pull all your money out at 65. In fact, you might want to keep some exposure to growth assets at that point to help your investment grow. So, it's not a one-size-fits-all situation. Now, let's talk about a common misconception. Some people believe that if you leave your money in a KiwiSaver fund beyond the age of 65, and the government changes the eligibility age for superannuation, your money is locked in forever. But here's the deal, technically, yes, that's true. But in practice, it's not something you need to worry about. The current law ties access to KiwiSaver to the age of eligibility for NZ Super, which is 65. So, if the age were to increase, the law would likely follow suit. But there are already discussions about whether that's the right approach. Some people think that having access to KiwiSaver earlier than NZ Super could be beneficial for those who want to stop working early. But again, these changes are usually signaled well in advance and take effect over time, so it's not something that would affect you as a recently retired person. Now, let's move on to a question about retirement funds. A listener asks whether PE, passive income entity, is automatically paid across to IRD, Internal Revenue Department, for a retirement fund. The answer is that retirement funds don't typically apply PIE, and if you withdraw funds or close your account, you'll need to inform the IRD and be taxed accordingly at your 17.5% rate. But here's the interesting part, when you're invested in KiwiSaver, you usually pay tax on the income your investments make, not the growth in the value of the investments. So, there's no need to worry about paying tax on the entire retirement fund amount. You also don't pay tax on withdrawals unless there's a square up to do on the tax you would normally pay in the year. Now, let's talk about PAE rates. Dean Anderson at Kernel suggests that if your fund has a fixed PAE rate of 28%, it might be beneficial to move to a multi-rate PIE that allows you to pay tax at a lower rate. This could be a better fit for your goals, especially if you're on a lower tax rate as a retiree. In conclusion, being more aggressive with your KiwiSaver is a personal decision that depends on your risk tolerance and investing timeframe. It's not a one-size-fits-all approach, and it's always a good idea to consult a financial advisor to make the best decision for your situation. So, don't be afraid to ask questions and seek guidance. Thanks for watching, and I hope this helps you navigate the world of KiwiSaver and retirement savings.